Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look at a number of different areas. I look at the valuation of the S&P 500 on a historical basis as well as a forward-looking basis. We do a pretty in-depth analysis of growth versus value. We want growth to be outperforming during more positive times in the market. And then we look at other markets. We look at sectors, we look at indexes, we look across commodities to see if we can get any insights as to what's ultimately happening with the S&P 500. This is being prepared for Monday, December 16th. Before I get into that, I want to tell you briefly about the SPX Investing Program. It's a program I've developed. It's up and going. There are additional videos that I post there, and one benefit is you get immediate access to the videos as they're prepared, where I hold them back on YouTube and Rumble. There's a link that'll take you to the website or to a video that talks about the program, and it's wide open right now until the end of 2024. And if you have any questions, you are more than welcome to send me an email. Also, this is the intermarket analysis video, just one of the weekly videos that I do where everything is meant to tie into the daily videos. So feel free to check those out. All right, let's go and look at S&P 500 valuation. First, we look historically where we compare price with past earnings, and that is measured by a PE ratio, the price to earnings ratio. And for a long time now, we've been above the PE ratio of 20, and that means that we are expensive on a historical basis. This past week, I've been hearing more concerns about valuation, especially on a forward-looking basis, which we'll talk about here in a moment. But we've been well above this red dashed line for quite a while. So I think what's concerning the market is you can see how far away down below that we're getting based on price to the historical earnings. This red line just keeps going up and up and up. And this should be a concern, but it's not really a concern in the bigger picture. It's just there are times when the market will look at this and go, oh my gosh, and then we might see a decline because we either have to see price come down, which would be a decline, or we have to see earnings go up, or a combination of the two to bring these lines more in proper order with each other. Okay, then you can also see what the historical valuations were going back to 1980 and then different events. And even during difficult times, we would spend a lot of time above this PE ratio of 20. Then Robert Shiller came up with a variation of this to try to get a more smooth effect, where it's called the Shiller PE ratio or CAPE, C-A-P-E. You may also hear this referred to as PE10 because he uses 10 years of earnings data to smooth it out. Right now, his calculation is coming in at 38.58. We're well above that 20 level. And to give it a little bit more perspective, it's the median and the mean are between 16 and 17, and we're coming in at 38. So, yeah, but we've been seeing this now for a long time, a couple years, at least, number of years. And so the market may choose to freak out over this and then justify, well, we're going down because of valuation concerns. But this has been going on now for quite some time. Then the market looks at forward PE ratios, and I have four different areas on here. This is a chart put out by Edward Yardeni. Or we look at the mega cap 8, that's the pink or purple or whatever color you want to come up with. We're well above 30 right now. We're at 30.9 with this measure. But folks are okay with that. They think, okay, Nvidia, Apple, Amazon, Netflix, Google, they're all going to increase with earnings. So I don't mind if they're expensive now because their earnings are still going up. So I'm still okay with their forward-looking PE ratio. Then the red line, this is the one I focus on the most. This is the S&P 500 forward PE ratio, and we've been above 20 now for a while. We're coming in at 22.1, and we'll have to watch this if we do get some positive seasonality with the small caps and the mid caps. We've been spending a lot of time right around the 14, 15 level. Well, if these stocks really go up, we're going to see this PE ratio going up too. Now, this is more fairly priced between 16.6 for the mid caps and 16.5 for the small caps. So when you just look at this, it's more fairly priced for the mid caps and small caps. But are the earnings there to justify prices actually going higher? And that's part of the debate that goes back and forth. It's like, okay, they look cheap when you look at them on a PE ratio, but if I go into individual companies or even the small cap indexes, are the earnings there like they are with the bigger companies? And that's part of the back and forth that people go through here. All right, then we look at growth versus value. Now, growth is doing quite well. Now, we had a kind of a down week this last week, but when you look at the bigger picture here, we are in a solid uptrend with growth. Where we've been seeing some weakness is an area that we want to see weakness, excuse me, when the market really is getting set to go higher. We see value really coming down now, and it's been in a downtrend, even though it's longer term, it's in an uptrend, but it's coming back down to its 50-day moving average. So where we get some real insight is when we do a ratio between the two, growth versus value. And you can see growth is really outperforming here. Then I do an inverse down below. This is showing how value is underperforming. And that's what we've been seeing since we finally bottomed in October of 2022. In the bigger picture, growth has been outperforming value. And then there are periods of time when this slows down a little bit. And that's typically when we see some weakness in the market. What we're seeing right now is we had a down week with the S&P and things were really turning more negative on our daily charts. We're seeing some internal weakness, but the mega caps are starting to come back in and really do better. And that's holding up these growth to value ratios, which could potentially set things up to be more positive going into the end of 2024. Now, we don't know what's going to actually happen. This could all get blown out of the water, but we are seeing the potential of a positive setup here as we also come into a period of positive seasonality. And we also look at the indexes of growth to value, showing how growth is outperforming. This is showing how value is underperforming. Then some other ETFs showing how growth is outperforming and really improved this past week. This shows how value is underperforming. And then we look at some indexes, also how growth is outperforming here. And then we look at a growth versus value ETF, and I show this in the daily video. This is really coming up out of the rainbow and coming back to the previous high that we set in July. Now, we fell down after that, after we got a really high reading here, but the market was it was a little more strong when we saw this happening last summer. We're setting real high readings here when the market's been a little bit weaker. Does that suggest that we might be able to go up from here, or is this just the beginning of some weakness that's going to end up following what we see happening? And then we look at value versus growth, showing how value continues to underperform. Then this is also encouraging. If you look at the index for the small caps where we shot up and then we've been trailing back, but look at the growth to value ratio here. We've seen a recent golden cross with this ratio and we're really holding up quite well. That could be positive for the small caps. And we're seeing pretty much that same thing with the mid caps. We shot up and then we've been giving back with the index, but this has been doing well and also a recent golden cross here. We've also been holding up when we look at growth versus value for the S&P. And so this is more positive, even though we're seeing some weakness when we look at other charts. Then we keep an eye on inflation, where the CRB index is going up a little bit here, but we follow mainly the moving average. This is monthly, and this is pretty much flat right now. So inflation is going up just a little bit here when we look at this chart, but not a real concern at this point. And then we do a ratio where we see the red line actually going down here when we compare inflationary to deflationary aspects and do a ratio between them. Here's a daily chart where we're trying to resume an uptrend here with the CRB index. We've been chopping around sideways. Well, over the last few sessions, this is starting to go up again, which could potentially be inflationary. Typically, what will happen, unless you get into times like after the COVID crash and the lockdowns, where everything was going up at that time, but if this goes up too much, that might be a little bit of a concern to the market. And then we look at the Baltic Dry Index, which continues to fall. And as a general rule, if this is going up, that's inflationary. If this is going down, that's deflationary. Then inflation expectations, not really breaking out, but seeing a little bit of a climb here near the higher end of the range. And this is a weekly chart. that can be kind of useful to keep an eye on. And we also keep an eye on some other markets like aluminum, which is in an uptrend, even though it's been pulling back. Corn, which is in a downtrend and it's been bouncing. Wheat, which is in a downtrend and kind of a jumbled mess right now. Keep an eye on fertilizer because that's a huge part of agriculture and different products that are grown. This has been pretty much going sideways lately. Gas, which is in a downtrend. And then diesel, another thing that affects how much it costs to ship products here, where it's mostly been going down. And we keep an eye on oil, which we're watching this for a number of different reasons, for economic reasons, but then geopolitical reasons, where we've been hanging out right around the 70 level. And we look at a gold to oil ratio where it's been chopping around here for the last number of days. And we look at a correlation between oil and the 10-year yield, and they're having a pretty strong tendency to go in the same direction. So if oil is going up, which is the red dashed line here, and the 10-year yield is also going up, it just shows down below, they're going in the same basic direction at the same time. And that's typically what we see here. And interest rates have been going back up. And that's part of the reason why we've had a difficult week last week with the market really having trouble going up because interest rates are starting to go back up. Natural gas also in an uptrend, heating oil in a downtrend, and copper, which is in a downtrend right now. It's still in an uptrend on the weekly chart, but we have been bouncing back up here a little bit. We're coming back up to the 200-day moving average. If we can break above that, this is generally used as a measure of the economy looking out into the future. When copper's doing better, they're anticipating the economy doing better. When copper's underperforming, that could suggest that the market is anticipating economic weakness. And we look at a copper to gold ratio, showing how copper continues to underperform gold. And then this is a longer term copper to gold ratio chart here, matching up with the 10-year and 2-year yield, where we've been going down with the copper to gold ratio. We've been going back up recently here with interest rates. Gold still hanging out around its 50-day moving average, and we're a little under the 50-day moving average with silver. We look at the closing price for gold and the closing price for silver, and we see that there's kind of a strong relationship between the two. You would think they go hand in hand, but they do get out of line with each other from time to time. The dollar, which is in an uptrend as well. And then we look at a gold to silver ratio, kind of going sideways for the most part here. Then we look at the relationship between this ratio and the US dollar index, and we see not a real strong relationship between the top chart and the middle chart. The euro, which is now in a downtrend compared to the dollar, and the Japanese yen also in a downtrend. And this is part of the change that we saw this past week. And this is it here, where we've really been going down with the euro to the dollar. Might be a good time to go to Europe if you want a favorable exchange rate. And we're seeing a death cross here as the euro's underperforming the dollar. And the same thing, where the Japanese yen had been in an uptrend compared to the dollar after really declining. Now it's seeing a death cross here as the yen is starting to underperform the dollar. And the British pound also getting close. In fact, we're generating a little bit of a death cross here. And again, you might want to, this might be a good time to consider going to Britain or Europe or Japan or something if you're concerned about the exchange rates. It's great if you're traveling. It's not as good if you're an international company doing business around the world. You actually want a weaker dollar and stronger foreign currencies because that helps the exchange rate to show more money on your books because the dollar is worth less than the foreign currencies. Then some index ratios, and I show this in the daily video. We're actually seeing a little bit of weakness in the broader market. The bar chart here is the S&P 500, where we've been chopping sideways. Well, the equal weight version of the S&P 500 has actually been going down, and that's the bit of a negative divergence that we see. But the S&P is holding up okay, and that's the bigger stocks that are really holding the index together, where the broader part of the S&P is actually seeing some weakness. And we look at a ratio between the equal weight and the S&P 500. When this is going down like it is now, that means the equal weight is underperforming. And we look at stocks versus commodities. We're still showing that stocks are outperforming. This shows how commodities are underperforming. The NASDAQ 100, which had been underperforming the S&P, and they're both coming off of all-time highs. A week ago, the S&P set an all-time high. This past week, the Nasdaq 100 set an all-time high. But now we're starting to see the Nasdaq 100 outperform, and that could end up being positive if we see more follow-through with this. Yet the bigger stocks in the S&P 100 are outperforming the rest of the S&P 500, which could be positive for the index. The Nasdaq, which is setting a new all-time high, and the S&P 500, which has a recent all-time high. This shows that the Nasdaq is outperforming, and this is more tech, where the S&P 500 is more balanced with growth versus value, where the Nasdaq is more pretty much value. The Nasdaq 100, which has been underperforming the Nasdaq, but we saw a bit of a bounce up here. If this could turn and go back up, which is going to take a while for that to happen, that just means the bigger stocks are outperforming the rest of the Nasdaq. But they're both doing well and coming off of recent all-time highs. Mega cap growth, this is where we're seeing a lot of the strength in the market. That continues to be strong. And we look at a ratio between the mega caps and the equal weight, and it had been chopping sideways, but lately, as the mega caps have been coming back in and taking over, this ratio has been going up. Small caps, we're wondering. We look at the ratio of small caps to S&P 500, and it has been declining. It's got a lot of work to do here, and we're not really seeing this going up, at least yet. Then the blue line here is the S&P 500. This is another way of looking at the ratio. Still in a downtrend with small caps to the S&P. To see this January effect or Santa Claus rally, whatever you want to call it, the favor of the small caps, which should be kicking into gear about halfway through December if it ends up happening, we want to see this ratio really going up. But we're just not seeing that, at least yet. Big software companies in a pretty good uptrend here. The robotics and AI ETF still at the top end of the rainbow. But when you compare it on a ratio basis with the tech sector, the robotics and AI ETF is actually underperforming and has spent a lot of the time inside the rainbow, and the rainbow is actually going down. Now, AI is supposed to be all the craze where everything's at these days, but you look at these prices on a ratio basis, and they have not been outperforming. The Dow Jones Composite Average, which is the Dow, the transports, and the utilities, pulling back, coming down to their 50-day moving average, but still in an uptrend. Then we look at a ratio of the S&P 500 to short-term bonds, showing how stocks are holding up and outperforming. Then we look at another ratio of small caps to the tech sector, kind of chopping around these days. We'll see how that works itself out. And then we're seeing some weakness here with the advanced decline line studies. We're dropping below the moving average with the NYC common stock. This is some of the weakness that I've been talking about over the past week, and it's a little bit of a concern when we drop below the moving average. Now, we could come back above that, but we need to see some real buying coming in. We're also dropping below the moving average with the S&P, the mid caps, and the small caps. So we're going to need to see some real buying come in to really turn things back more positive. As of right now, it's looking more negative. And we're also seeing this with traditional Dow theory, where we've been coming down with the Dow after setting an all-time high a week ago Friday. The transports have been declining, and we're also declining with the utilities. Here are the transports, looking pretty solid there for a while, but now starting to pull back above this previous all-time high. And we look at the ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. And we actually dropped down a little bit, but we're seeing a bit of a recovery lately. And this is a ratio between the transports and the S&P, where we've been pretty much going sideways lately here. And the correlation was actually that they were going in opposite directions, but we're seeing this starting to improve, but we're not quite up to this red area yet. If we get up to this red area, that means they're going in the same direction at the same time, either up or down. Then we look at new Dow theory, which instead of using the Dow, we use the S&P, coming off of a recent all-time high, but showing some recent weakness. And then the NASDAQ, which is setting an all-time high. So according to this, this is a non-confirmation at this point, where we're setting a high with the NASDAQ, but not with the S&P 500. And then we break it down a little bit more, looking at the equal weight version, which has been under pressure lately. And then the equal weight version of the QQQ is also coming off of its all-time high. The FANG index, this is where we're seeing the strength. Facebook, Apple, Amazon, Netflix, Google, Nvidia, setting an all-time high even in Friday's session. And we're starting to break above this short-term trend line. If we can stay above that, that would be more positive. The Wilshire 5000, a broad market measure, just kind of drifting sideways here. Also drifting a little bit with the total US stock ETF. Low volatility stocks. These are more defensive. These are what folks get into when the market is getting ready to go down. When you look at them all by themselves, doing okay, a little bit under its 50-day moving average. But when you compare it to the S&P, really underperforming. And that's what we want to see. If the market was getting ready like it was at the end of 2021, into 2022, we would see this ratio really going up. We were kind of jumping around here for a while, but for the most part, this ratio is now going down, which could end up being positive for the market. ARC also in an uptrend here and has a lot of damage to repair, but looking a little better. Then we look at the all world ETF without US stocks. Came down to its 200-day moving average, back up to its 50-day moving average, and senses right in between the two moving averages. Then we look at a ratio showing how the US stocks continue to outperform. This is a longer term chart, a monthly chart of US stocks to world stocks, showing how US stocks are outperforming here. And that is also measured by a longer term oscillator that's going up. And coming down here with the price of the 10-year bond, which we're a little bit concerned because interest rates are now going back up. And the total bond ETF, kind of still in an uptrend here, but kind of dealing with its 50-day moving average. And the world bonds getting really close to seeing a downtrend here, but we've been really choppy with this index. But longer term, stocks continue to outperform bonds. This also shows how bonds are underperforming stocks on a daily chart. Here's junk bonds coming off of a recent all-time high and still looking pretty strong. More conservative bonds pulling back a little bit more here, but still in an uptrend. And then we do a ratio between junk bonds and government bonds, more conservative bonds. And we're still at the top end of the rainbow here. Folks are still preferring the riskier bonds for the most part. They're willing to take on that risk. They're not seeing a lot of risk in the economy right now, but they want to get that yield. So they're willing to get into riskier bonds, at least for right now. And we look at the stock to bond correlation, slight tendency for stocks and bonds based on price to be going in the same general direction. Corporate bonds in an uptrend, still dealing with its 50-day moving average. And nothing to really show here. I use these charts because I look at them all the time. These are fib retracement levels based on the 10-year yield. Then here's a longer term look at the 10-year yield where we are starting to establish a higher range. And nothing really here. This is also fib retracements based around the 30-year yield. And then we look at a ratio between stocks and the 10-year yield, and stocks are continuing to outperform here. Junk bonds looking really solid all by themselves. And then we do a ratio between junk bonds and government bonds. Junk bonds are back to outperforming. And this is a daily chart of yields where we were really coming down and the market was liking that over the summer. And then the Fed came in and cut rates, and then interest rates started to go back up. And then we were looking a little more positive as interest rates are coming back down. But over the last week or so, interest rates have been going back up. And that's put some pressure on the market. There's a weekly chart showing that US and UK rates are going up as are German rates, but we're coming down a little bit with Japanese rates lately. Then we look at the volatility of bonds. That's measured by the MOVE index. Very, very low volatility right now. The VIX has really come down. That's the volatility of stocks since the election. It's really dropped down here. And we're seeing the correlation between the two. It's pretty much neutral right now. We look at a broad market measure, the S&P 1500 with short-term bonds, showing how stocks are outperforming. Broad market with further out bonds, stocks are outperforming. Tech sector, 3 to 7 year yield, showing an improvement here. This going up would be more positive for the tech sector. And this also shows how bonds are underperforming stocks as this ratio goes down. Then we look at a longer term chart here. This is the 30-year ETF based on price, where we're dropping below the moving average. But when you compare on a longer term basis, the long term bond with commodities, we're still seeing this ratio going up as bonds are outperforming. Then I go through the different sectors. Materials been getting hit pretty hard lately. They're actually dropping below their 200-day moving average. and also really underperforming when we do a ratio with the S&P. Communication, this is a growth area. These are areas we want to see really doing well, coming off of a recent all-time high with the sector here, and also holding up pretty well when compared to the S&P. Energy, which has really been pulling back, falling under its 200-day moving average, and really underperforming the S&P on a ratio basis. Financials, seeing some profit taking here. We're keeping an eye on this. This is usually a little more weakness than what we've seen recently. If this could go back up, that would be more positive for the market. And you can see that pullback here compared to the S&P itself, but the financials overall are still outperforming. Industrials coming back and falling a bit under their 50-day moving average and still in an uptrend compared to the S&P, but seeing some recent weakness here. The tech sector, this is the area that folks want to see really doing well, coming off of a recent all-time high and going sideways because both the tech sector and the S&P 500 have been doing quite well. So we're not really seeing an outperformance here. In fact, the tech sector is still in a downtrend compared to the S&P. Staples sector, this is more defensive. You look at this all by itself, looking pretty positive, but when you compare it to the S&P, it's underperforming. And real estate, in an uptrend, but really seeing some weakness right now as interest rates have been going back up. And utilities, which were coming on strong, still in a longer term uptrend, but we're seeing some weakness as this area is pulling back. And real estate here also dropping below its 50-day moving average. And then utilities are still in an uptrend, but we're seeing a lot of sideways action here when compared to the S&P. Then I also do another ratio of the S&P to utilities. When this is going up as it is now, that means the S&P is outperforming, but we're not seeing any real definitive trend with this ratio, at least right now. And then healthcare, which is more defensive, seeing some weakness here, in danger of seeing a death cross if that continues. And the healthcare sector is really underperforming the S&P. Discretionary, another area that has done really well since we saw that big down day at the beginning of August. This has been the strongest area of the market. And it's really improving when we compare it to the S&P. This is another growth area. And if you're more positive on the market, you want to see this area outperforming. And then it's a ratio between the energy sector showing how it's underperforming the tech sector. Not like it was back in 2022 when energy was outperforming and then we went into a bear market. As long as this keeps going down, that's more positive for the tech sector. This is an area that's a bit of a concern with the semiconductors actually falling below its 50 and 200-day moving averages here. When we just look at the SOX index itself, and we look at this ratio, when this was really going up in earlier 2024, that means the semiconductors are outperforming the tech sector. Then we topped in the summertime in July, and then this has really been underperforming. We did get a nice little bounce in Friday's session. We want to see this continue to go up to see more improvement with the semiconductors. And this is the SMH, which is the semiconductor ETF where we've broken below the 200-day moving average here, and that's what's been causing me some concern here. But when you look at this ETF, we're still above this 200-day moving average, and this is what the market may be using as support. We came down to this a couple of times before, and we're able to bounce up off of that. If we can continue to bounce up off of that and get more above the 50-day moving average, that will be more positive. And this is just a rainbow look here at the semiconductors where we really were doing strong into July and we've just been kind of chopping sideways, even though we are showing a little bit of improvement recently. And we look at a ratio between growth stocks, which is what we want to see outperforming bonds, and then the tech sector compared to the 10-year yield, kind of going sideways here, but the tech sector is still outperforming the 10-year yield. This is an inverse of that same thing, how the 10-year yield is underperforming the tech sector. Discretionary to staples. We like this if we're positive on the market. We want to see discretionary outperforming staples. We want to see staples underperforming discretionary. And then gold to S&P. They both have been doing quite well. And even though it's in an uptrend with gold in an uptrend compared to the S&P, we've been seeing a lot of sideways action here. And gold to the dollar's been doing well, but gold's been doing well. And this ratio overall has been holding up. This is another barometer that I use for the economy. High leverage loans, very risky. They're not even coming down. They're not even close to their 50-day moving average. So this is still suggesting things are positive. And we look at all stocks, which are still pulling back, but in a longer term uptrend. The NYSE composite didn't set an all-time high this week, coming back down to its 50-day moving average, but still in a solid uptrend. Emerging markets coming back to the 200-day moving average, but bouncing back up, now dealing with the 50-day moving average. And the Japanese Nikkei coming right back up to this jumbled amount of previous closes here. You can't really seem to break up or break down with this index. And the small micro caps here, the smallest stocks, seeing some recent weakness coming back down towards their 50-day moving average. And we look at the home builders ETF, and we're seeing that the top chart, the S&P and the home builders ETF, the correlation between the two is quite strong. So they're going in the same direction at the same time. Bitcoin, which finally got over 100,000, it's just kind of camped around those levels lately. And then we look internationally, where we're starting to see a turn back up in China as the government there has been announcing some more stimulus and lowering interest rates and doing things that could really help the economy and help their stock market. Going back up with the emerging markets, Europe's in an uptrend, Japan's in an uptrend, and we're kind of flat right now in the US. We're wondering if that's going to turn back into an uptrend or develop into more of a downtrend. Then we look at correlations between the S&P and the dollar, neutral right now. Not really getting any insight there. S&P and oil, neutral right now. There could be some kind of a shift going on in the market. And S&P and the 10-year yield, just a little bit below neutral right now. Here, the tech sector to the 10-year yield, also neutral. When we get into this middle area, that's what I mean by neutral. When we get above the blue line, that means they're going in the same direction. When we go below the red line, that means they're going in the opposite direction. And they're tending to go in the opposite direction here as the S&P has been going sideways and the 2-year yield's been coming back up. And then we look at some long-term charts. This is a monthly chart of the NYSE, still looking pretty solid here with an upward sloping trend line, or moving average. And we're still going up with the Copic curve longer term. This is a daily chart. We're seeing a little bit of weakness here with the NYSE record high percent index, but this is still looking positive. Here's a monthly chart of the S&P, still looking really solid there, and the momentum is positive. And then we look at the S&P on top. This is a daily chart. And then the ratio between stocks and commodities, like we looked at earlier, showing how stocks are outperforming. Then another look at the S&P and then global stocks starting to turn back up with the KST as US stocks are outperforming. Then at the end, I go through a list of positive things, and this is when the 50-day moving average is above the 200-day moving average. So when you look at growth and value all by themselves, they are in uptrends. Copper, starting to establish more of an uptrend, and the dollar is in an uptrend. Gold and silver are in uptrends. The big software companies, mega caps, the FANG index setting all-time highs just in Friday's session. ARK is in an uptrend. The low volatility ETF all by itself is in an uptrend. Staples they're in an uptrend, and the Dow Jones Composite Average. Then all the bonds based on price. We're seeing a little bit of vulnerability here with the Pring World Bond Index. We'll be watching that one. Tech is in an uptrend. High leverage loans, that's another barometer of the economy. The Dow, the NYSE, and Wilshire are in uptrends. The NASDAQ and NASDAQ 100 setting all-time highs this past week. Mid caps, small caps, and micro caps. We're wondering if they're going to be able to break out and actually see some real improvement there. All stocks, emerging markets, and Bitcoin. All of these are in uptrends. Then when the 50-period moving average goes below the 200-day moving average, that's a downtrend. And the CRB index, which is kind of fluctuating back and forth here. But this is a new addition. The euro, the yen, and the British pound compared to the dollar have now established downtrends. And then the SOX index, when you just look at the SOX itself, but when you look at the SMH, the ETF, it's holding up above its 200-day moving average. Thank you. I hope you found this helpful. Have a really, really good weekend, and I will talk to you in the next video.